Welcome to the My Favorite CPA podcast. Today is September 14, 2023, and have we got some things in store for you. But very first, before we get started, I want to talk about something that would be interesting to anybody that's in business, like a small business, like a family-owned business. And here it is. September 15th is the date that estimated tax payments are due. So a lot of people get puzzled about what are estimated tax payments and why do I need to pay those if I have a small business? So I've had people asking me these questions, so I'm going to take a few minutes and just put out there for everybody to soak up the knowledge, what estimated taxes are, and how to go about them, particularly if you don't have a small business accountant, a CPA, or an enrolled agent at this point. So estimated payments, if you are an employee and you get a paycheck every week or every other week, you are paying taxes in because they're being withheld, federal and state tax and FICA tax, every paycheck. So you get your taxes paid in, and then you get your W-2 and you file your tax return, right? When you file your tax return, you will list your gross pay on your tax return on line 1, and then you will list all the other sources of income and deductions on your tax filing. Then you will figure your tax, and then there's a line where you list what you paid during the year. So you take your total tax and you subtract from it what was withheld on your W-2. If your tax is less than the amount of your withholdings, well, you get a refund, which sometimes people call their tax return, but a tax return is the actual form, and the refund is a refund. But if you're getting a refund, I want to go here for a second. If you are getting a refund, this might indicate to you that you overpaid all year long, especially if you're getting a large refund. I myself, I'm not really a fan of giving the government a loan, because you could have that huge amount. If you're used to being overpaid, you could have that huge amount in your bank account earning interest. And if you shop around, man, interest rate todays are getting to be between 4 and 5%. Not too bad. Now, let's talk about what if you're self-employed. If you're self-employed, or if you're a business owner, family-owned business, you don't really have, not everybody has a mechanism to get taxes paid in. And so that leads us to what the government calls estimated payments. There's a common urban legend out there that if I pay estimated payments, every time I figure estimated payments, I'm paying in the amount of tax that I'm going to owe for that time frame. And I think that's really a misnomer. I think it's a tax myth. I think it's an urban legend because, man, it is really hard to know what your tax burden would be. Particularly for one reason alone, estimated payments, sometimes people will call them quarterly estimated payments, but these quarterly estimated payments are not due evenly every 3 months during the year. No. Instead, they are due April 15, July 15, September 15. Actually, I said that wrong. April 15, June 15. That's where I made the mistake. September 15 and January 15th. So if you start to do the math, it's 4 months, another 2 months, then 3 months, then in January. Don't make me do complicated math. So they're not really truly quarterly, and this can be frustrating for business people because if there's something you do every month or every week, you're going to probably remember to do it, right? But if you're only doing it every 2 months, and then every 4 months, and then every 3 months, and every 5 months, yeah, you're probably going to forget unless you have a system to remember it. So let's talk about what the estimated payment taxes are based on. In a perfect world, if you had a crystal ball and you knew exactly how much you were going to owe for each of those time frames that are uneven throughout the year, maybe you could pay it. But the reality is, if you had a good quarter followed by a weak quarter, followed by a good quarter, followed by a weak quarter, or any pattern you want to make up, you wouldn't necessarily be paying the actual correct amount, right? So it's kind of an exercise in estimating and in judgment. But what do we do as practicing CPAs and as tax accountants? Here's what we recommend. We use a rule of thumb that the IRS calls the safe harbor rules. And the safe harbor rules work like this. You pull out last year's tax filing, and you look and you find the total tax line on your tax form. Total tax is what the government kept from you on last year's taxes. So, for example, we're in 2023. You would pull out your 2022 tax filing, and you would look at the total tax. Then, if you were not getting any taxes paid in through withholdings, like from a retirement plan or a W-2, or sometimes people have taxes withheld from investments. It's kind of rare, but it's possible. If you did not have taxes withheld that are paid in by another source, if the only way you could get taxes paid in is through estimated payments, you would take last year's total tax, divide it by 4, and you should be paying that each time an estimated payment is due. Now, generally speaking, that would be the safe harbor rules. If your income, if you're a normal, regular person who is not determined to be high income, according to IRS, then you just need to pay the amount they kept from you last year divided by 4. Now, if you are considered high income, and you would know if you are, and the amount changes, regularly every year, then you really should be paying 110% of the amount that they kept from you for last year. But here is the silver lining. If you do make all these payments and timely, you could have a year where you have, let's say your year is much, much better. You're making $1 million more, or you're making tens of million dollars more, and you owe $1 million more tax to IRS than you did for last year. Well, you don't have to pay that all 4 quarters each year. You can just pay the 4 payments that are based on 1 quarter of last year's taxes, or 1 quarter times 110% if you're high income. And then you figure your taxes here on your 2023 form, and you might owe $1 million, but if you paid those 4 payments in the amount that you should, even though you might owe tax, it's not a problem. There are no penalties. Now, what happens, I'm leading up to this, what happens if you don't pay those quarterly estimates? Well, the IRS can bill you tax penalties. In tax penalties, it's kind of complicated in my mind. It's often hard to predict. Just know this. 1, penalties are avoidable just by doing what you're supposed to do. 2, penalties work kind of like interest. So there's a lot of factors that come into play. It's complex. If you just follow the rules of looking at last year's total tax, dividing it by 4, or last year's total tax times 110% divided by 4, and paying that in during the year, you should be safe from penalties. There's another safe harbor rule that you can use if this is a down year for your income, but I don't want to get into that here in this video. If that's something that might affect you, drop a note in the comments, and I'd be happy to detail that out a little bit further. Now, I'd really like to talk about something that just popped up on my news queue today. This is very exciting here in the land of Indiana. And this has been happening throughout the entire country. I've read about it a couple times over the past few years, and I've done some other videos, like in my shortcut videos, like on TikTok or YouTube Shorts, where I have talked about this. And here it is. Oh, are you ready? Some states, including Indiana, are talking about just getting rid of state income tax. Wow, did you hear that? Getting rid of state income tax. So, what kind of bills do states have, and how do they pay those bills? Well, they pay them from tax revenues, and typically a state's tax revenue sources would be a couple different sources. They would be income taxes, sales taxes, property taxes, and I'm sure there's a bunch of other tax sources, from excise to, I don't know, whatever. But for the purposes of this video, in this conversation, let's start to focus this in on income tax and on withholding tax. In fact, as far as that goes, let's jump over the article, and I'm going to put a link in the video and wake my laptop up here. Okay, so here's the video that came across my news feed today. It's by an attorney down in the Indianapolis area, apparently. His name is Abdul Shabazz. Yeah, I hope I'm pronouncing that correctly. And it's titled, Brother, Can You Spare a Few $billion? And here's what he's talking about. Indiana lawmakers are looking at eliminating the state income tax. And like I said before, other states have talked about this. And there's been talk about it in Indiana previously. So he talks about how the logic and rationale in some respects is pretty simple. There is a task force called the State and Local Tax Review that is examining the state of Indiana's corporate individual property sales and other taxes. So let's see. Gubernatorial candidate Lieutenant Governor Suzanne Crouch, she is endorsing this movement. I guess AXE is what they're calling it, which is kind of a cool name if you ask me. Basically, this task force is talking about how can we eliminate the state income tax. And so part of the theory, the author says in the article, is the state has been in great financial shape over the past few years, maybe the past decade. I remember a couple times, was it a year or two ago, where, was it last year? Everybody got an extra refund above and beyond their normal state tax refund. They got a little chunk. And I think that happened not only last year, but like 2 or 3 years ago. And maybe another 5 or 6 or 7 years ago before that. So what does that tell us? It tells us that, the state is bringing in more than the cost of government programs. And that's really good. So let's jump back to the screen here for a second. And the author talks with Ball State University economist Mike Hicks. And he says that the share of state funding on education has been dropping, and that Medicaid and general fund spending has been growing. Basically, and I think this is a really important part right here, so I'm going to highlight it. In Indiana, anyway, education and Medicaid run about 70% of the state's spending budget, which is huge. Now, then he talks about, well, how much out of that state spending budget does income tax cover? Well, as it turns out, income taxes make up slightly more than 38% of all spending, at least as of 2021. So, which represents 55% of the budget, if I'm understanding this correctly. This is huge. This is huge news. If Indiana was to make a change like this, how do you think it might affect the economy here? Do you think business would move here? Do you think employees would want to move here? Do you think the overall standard of living would increase because everyone has presumptively more disposable income here? Or on the flip side, and this is something to think about, and I think he's going to address it later in the article here, if income tax goes down and you have more disposable income, they have to make up for it somehow. At least that's what the author says in this article. Does that mean that maybe perhaps sales tax would shoot up from 7%? Let's look at that here in a second. I want to say one other thing right now, which is I just thought about another state that has been considering this recently, and that is the state of Kansas, if I'm not mistaken. So if anyone has information on that, drop that in the comments. I'd love to engage a little about that. Is your state thinking about dropping income tax? Are they doing things to lower taxes? I personally, as a business CPA, anytime taxes fall, I see my businesses and my business owners prospering and appreciating that. So back to the article. So the economist from Ball State University, Mr. Hicks, he says that closing the gap, if they got rid of the income tax, means that they would have to push sales tax up maybe another 6 points. So we would go from, we could go to like 13%. So a 13% sales tax. How would you feel about that? And how would you respond to that if you're a Hoosier? Would you spend less? Would it not change your life a bit? Would you do what you normally do? Would you drive to another state with a lower tax? What would you do? How would you behave? How would it affect behavior? Let's see here. And he says here in the article, that, changing sales tax rates, changing income tax rates, this could really definitely anger certain populations. It could drive people, as I say, to the streets with pitchforks and torches. You think about other times that the government has messed with taxes in history and what's happened. I mean, you can go all the way back to the founding fathers in Boston and the harbor and when they dumped the tea in the harbor. People take taxes and changes in taxation and heavy taxation. They take that very seriously and very personally. It affects me in my pocketbook, right? It's very political. So I can't really address politics, but in typically as a business CPA, we're not usually talking about potential changes to, tax law and politics because I can't deal in what could happen in the future. I can't give my clients really confident advice about here's what could happen in the future. But I think this is something worthy of paying attention of because if it gains traction, wow. He goes on to say, back to the laptop here, imagine blowing a 38% hole in your personal budget. So if the state were to cut its own funding by reducing income tax, they would have a 38% shortfall. So if your income dropped 38% in your household, how would you make things up? He talks about what other taxes would have to be increased. Maybe it would be beyond sales taxes. Would property taxes have to come up? Both property tax and sales tax. Oh, and he even mentions right here in the article, this is great. Other states have tried it, and perhaps this author is, I don't know if he's in favor of it or against it, but he says, man, look at Kansas because they tried this and they ended up with a 900 million shortfall. Well, I guess that's not as bad as billions of dollars, is it? So again, I'm not a politician. I'm not a politician at all. I think I leave some of this stuff to legislators to really wrestle and think about what's the right thing to do. But I am a business CPA, and I know that taxes drive behavior, and it helps people decide, am I going in business, in self-employment, or am I going to stay doing what I'm doing? Do I want to retire here in Indiana, or do I want to retire somewhere else? And that kind of stuff. It definitely affects behavior. In fact, that does remind me of something they taught us in tax school, which I've said before on video, and that is, why does tax law exist? Most tax laws exist for two reasons and two reasons only. So sometimes when you're looking at a tax law and you're asking yourself, this is weird. Why do we have this tax law? Well, tax laws exist either to raise revenue for the government so they can cover that 38%, or number two, to legislate behavior. So if you have a law, are we trying to raise revenue so the government could run and do streets and education and Medicaid and that kind of stuff? Or are we trying to drive behavior? Like under federal law, you get a deduction for being a homeowner and that kind of stuff. Whereas I guess what I want to say here is in the United States, it's long been policy that we want to encourage home ownership. In other countries, Europe, for example, I don't think home ownership is as prevalent because the policies and the laws don't really legislate that behavior. Here in the United States, the longstanding policy has been you get deductions and benefits, tax benefits, because we want to encourage Americans to be homeowners. So tax laws exist for two reasons: raise revenue for the government and legislate behavior. Now back to the article. I guess what the author kind of wraps up here saying is, I personally wouldn't mind an elimination on income tax. I think what he's saying is, as long as they're responsible and not reckless. And I can totally get on board with that. I think you can too. If you're in business, we do not want the government being reckless because we know that, if legislators make reckless decisions, who does that ultimately affect? It affects us as taxpayers because we're going to have low taxes one year and the next year is going to shoot through the roof. I think this is a great article. I'm super excited about it. I guess at some point I might even reach out if this attorney Abdul Shabazz continues to write about this and give updates. I might reach out. If you guys are interested and think we should have him on the podcast, drop a comment and I'd be happy to make that call, send that message, and do that invitation. So, having said that, that is my topic of the day, estimated taxes and the potential elimination of income tax. At least there's a conversation here in Indiana. It's going to be interesting to see what happens.